A winning week on Wall Street, the energy is electric, and optimism is in the air as traders and investors alike celebrate a remarkable run. The iconic New York Stock Exchange is buzzing with activity, and the mood is a far cry from the uncertainty that gripped the market just weeks ago. The bears are in hibernation. For now, the bulls have taken center stage, charging ahead with confidence and leaving the pessimists behind. This week, the major indices flashed green, notching a fourth straight day of gains. The rally has been broad and powerful, with nearly every sector participating in the upswing. This isn't a fluke, it's a trend. The momentum has been building for days, and the consistency of these gains is catching the attention of even the most skeptical analysts. The S&P 500 is closing in on its all-time high. Investors are watching closely as the index inches ever closer to breaking new records, a sign of renewed confidence in the market's future. The Nasdaq Composite was the real star, posting its ninth positive close in 10 sessions. Tech stocks are leading the charge, with innovation and growth stories fueling investor enthusiasm. That sustained momentum and real conviction. The mood on trading floors is upbeat, and there's a sense that this rally has real staying power. The S&P 500 and Dow Jones also joined the rally, showing this is a broad-based move. It's not just a handful of stocks, strength is showing up across the board. The fear that gripped Wall Street is melting away. Volatility is down, and confidence is returning as investors shake off recent worries. Investors are betting the worst is behind us. There's a growing belief that the market has weathered the storm and brighter days are ahead. This kind of winning streak builds FOMO, fear of missing out, and can push markets even higher. As more people jump in, the rally can feed on itself, creating a powerful upward cycle. What's fueling this fire? It's a mix of strong economic data, robust corporate earnings, and, most importantly, shifting expectations about the Federal Reserve's next moves. Hints of possible rate cuts or a pause in tightening have given investors a reason to cheer. The party's just getting started, and you need to know why. With so much momentum, the next few weeks could be pivotal for the market's direction. Let's dig into what's driving this bull run, and what it could mean for your portfolio in the days ahead. You might wonder, what does this rally mean for me? The answer: everything. Even if you don't follow the market every day, its movements ripple through your life in ways you might not realize. Whether you're just starting your career, saving for a home, or planning for retirement, the stock market's performance can shape your financial future. The stock market reflects the health of the economy and the companies that power our lives. When the market is strong, it's a sign that businesses are thriving, innovation is happening, and opportunities are growing for everyone. When the S&P 500 and Nasdaq surge, it signals growth, more jobs, and higher profits. It means companies are expanding, hiring, and investing in new ideas. This momentum can lead to better wages, more job openings, and a stronger sense of security for workers across the country. Your 401k or IRA is likely invested in these indices, so when they rise, your retirement grows. Even if you're not checking your account every day, your nest egg is quietly compounding, helping you build a more comfortable future for yourself and your loved ones. These aren't just paper gains. This is your future getting brighter. Every uptick in the market can mean more options, more freedom, and more peace of mind as you plan for what's next. A strong market boosts confidence, encouraging companies to invest and hire. When businesses feel optimistic, they launch new projects, expand their teams, and create opportunities that benefit entire communities. That creates jobs and stimulates the economy, a virtuous cycle. More people working means more spending, which in turn fuels even more growth and prosperity. The wealth effect makes people feel richer, leading to more spending and further growth. When you see your investments grow, you're more likely to make big purchases, support local businesses, and invest in your own dreams. Don't let anyone tell you the market doesn't matter. It's the engine of our economy and your wealth. Its impact reaches far beyond Wall Street, touching every main street in America. Watching the S&P 500 climb isn't just for the rich, it's a sign the American dream is alive. It's proof that hard work, smart investing, and a little optimism can pay off for everyone. Understanding these moves is the first step to taking control of your financial destiny. So stay curious, stay informed, and remember, this winning streak is your opportunity too. Booyah! Let's get to the main catalyst behind this rally: the Federal Reserve. Next week's Fed policy meeting has everyone on edge. The Fed controls interest rates, and for years, they've been raising them to fight inflation. Now, the market is betting the next move is a rate cut. A shot of adrenaline for the economy. According to the CME FedWatch tool, there's an 87% chance of a rate cut next week, up from 62% just a month ago. The market isn't just hoping for a cut, it's demanding it. If the Fed delivers, the rally could continue. If not, brace for a sell-off. All this optimism is built on the hope of a more dovish Fed. That's why next week's meeting is the most important event on the calendar. Everything is riding on it. The stakes couldn't be higher. Stay tuned. Why does the market believe the Fed will cut rates? For months, investors and analysts have been searching for clear signals that the era of relentless inflation might finally be coming to an end. The Federal Reserve's every move has been scrutinized, with markets hanging on every word and data point, hoping for a sign that relief is on the horizon. The data is finally telling a new story, one that's giving both Wall Street and Main Street a reason to breathe a little easier. Inflation, the main villain in this economic saga, shows real signs of cooling. After months of stubbornly high prices, the numbers are finally moving in the right direction. The latest PCE price index, the Fed's favorite inflation gauge, rose just 0.2% for the month, right in line with expectations. This is a crucial signal that inflation is not just slowing, but doing so in a predictable, manageable way. No nasty surprises, just steady, manageable inflation. For investors, this kind of stability is almost as good as a win. The labor market is also cooling gently, not collapsing. Fewer job openings and a slower hiring pace suggest the economy is easing off the gas, but not slamming on the brakes. Companies cut 71,000 jobs in November, but jobless claims are at their lowest since September 2022. This means layoffs aren't spiraling out of control, and most people who want work can still find it. This Goldilocks scenario, not too hot, not too cold, is exactly what the market wants. It's a rare balance that keeps both investors and policymakers cautiously optimistic. The economy is slowing just enough to curb inflation, but not enough to trigger a recession. It's a delicate dance, and so far the steps are landing just right. This gives the Fed room to ease up. With inflation cooling and the job market steady, the pressure to keep rates high is finally starting to lift. The data is finally aligning with market hopes. For the first time in a long while, the numbers and the narrative are moving in sync. Optimism is blooming on Wall Street. Investors are starting to believe that the worst may truly be behind us. The inflation dragon is wounded, not roaring back. While risks remain, the threat feels less immediate, and hope is returning to the markets. The Fed may finally have the cover it needs to pivot, potentially marking a turning point in this long battle against inflation. It's not just the data. Main Street is feeling better too. The University of Michigan's consumer sentiment reading rose for the first time in 5 months, beating expectations. People are starting to feel better about their finances. What's driving this optimism? Lower inflation expectations. When people expect prices to stabilize, it helps anchor inflation. Consumer confidence is critical. 70% of the US economy is driven by spending. A confident consumer means a growing economy. Even a small rebound in confidence is bullish. This could support spending through the holidays and into the new year. The Fed may be able to pull off a soft landing, slowing inflation without causing a recession. A happy consumer keeps businesses profitable. Combined with cooling inflation, this is a powerful 1-2 punch for investors. The US economy is healing. Even in a market driven by big trends, individual stocks can make waves. This week's blockbuster Netflix's $72 billion deal to acquire Warner Bros. Discovery's studios and streaming unit. Netflix gains a treasure trove of content: HBO, DC Comics, Warner Bros. Movies and more. This move consolidates power and content, making Netflix even more dominant. HBO Max joins the Netflix fold, taking a major competitor off the board. The market's reaction? Netflix shares dipped nearly 3%. Investors worry about the price tag and integration risks. Warner Bros. Discovery shares soared over 6%, a lifeline for a struggling company. For WBD shareholders, it's a big payday. This deal will reshape the streaming landscape for years. It's a classic, buy the rumor, sell the news for Netflix, and a relief rally for WBD. Content is king, and Netflix just bought the kingdom. The entertainment world just changed. Not all tech giants had a smooth week. Nvidia, the AI chip leader, slipped nearly 1% as new competition from China's More Threads emerged. Even more troubling, US lawmakers proposed the SAFE Act, which could block Nvidia from selling high-end AI chips to China for 30 months. Geopolitical risks are real, even for the biggest players. Tesla also stumbled, facing weak sales in Europe. To respond, Tesla launched more affordable versions of its Model 3 and Model Y. It's a smart move, but signals growth is getting tougher. Even the best companies face constant threats, competition, regulation, and shifting demand. Stay alert, the road ahead won't be without bumps. Beyond big tech, the market had surprises. Victoria's Secret surged nearly 18% after a blowout earnings report and raised guidance. A classic comeback story. The company's rebrand is finally resonating, rewarding brave investors. Gold, the old-school safe haven, had a solid week, supported by Fed rate cut hopes. When rates fall, gold shines as an insurance policy against uncertainty. Meanwhile, Bitcoin tumbled below $90,000, down over 4% in 24 hours and 3% year-to-date. Institutional investors are pulling back from crypto, favoring stocks and gold. In this environment, tangible earnings and safety are winning. There's always a bull market somewhere, if you know where to look. Diversification is key. So, what should you do now? Don't panic or get greedy. A 4-day rally is great, but markets can turn fast. Stick to your plan. This is a time for careful, deliberate action. Focus on companies that benefit from lower rates, strong balance sheets, real earnings. Avoid speculative, profitless stocks. Look for bargains among quality companies unfairly punished by rate fears. Diversify. Tech is hot, but Victoria's Secret and gold also performed. A balanced portfolio helps weather any storm. The market is signaling opportunity as fear fades and optimism returns. Review your holdings. Own the best-of-breed leaders. If you've been waiting in cash, this could be your entry point. Don't jump in all at once, but start putting cash to work. The bulls are running. Don't get left behind. Booyah!